right now, and we'll begin. Today, I'm going to be speaking a lot about gold, and I'm pretty much going to give you information that many brokers, mentors, and teachers, and pretty much everybody else that falls under that category cannot, and if they can, probably will not. But before I begin, I've got a very quick question for you. Who here trades gold? Good evening, Peter. How's it going, and what time is it over there? 10 p.m. Okay, perfect time. That's good. Okay, so we have a couple of people that trade gold. Okay, now I'm going to give you a quick update on gold. Gold can be a very profitable commodity to trade and even invest in. As the sessions go by, I'm going to teach you quite a bit about gold and about how it's connected to different pairs and so forth. But before I go into anything else, I just want to tell you very quickly about the connectivity of gold, for example, to the Australian dollar, South African rand, commodity producers, basically. For example, Australia is ranked just about third, South Africa's first in gold production, and then you have some very big buyers like Russia, USA, Canada, and many other countries. But I want to also tell you that in times of economic struggle, people that turn to gold are people with billions and millions invested. So it's not always the best thing to turn to. However, trading it on a trend basis, basically on a trading gold as a trend, can and is extremely profitable because the moves on gold are much bigger normally than in other assets. Okay, you do need more equity to open positions. That can be seen over here. You can see that the leverage also normally is smaller. You see maximum leverage is only 50 and not 100 like the currency pairs, as you can see on this one over here, for example. Okay, here you go. You see maximum leverage 500 and so forth, but we're only giving 100. So also the movement of it, like I said, the movement is much more rapid. So what I want to do today is give you some information on gold, especially now that quarter one has ended and we're already in quarter two, and some impressive information has just been released. So the demand for gold worldwide has risen substantially, very, very, very highly, with the price of this precious metal even surpassing the 1.3 level. Not breaking it, but passing it and closing right under it. So we've even come very, very close to the 1,300 per ounce. And this is for the first time, and please pay attention to what I'm saying. This is the first time price reaches that level in 15 months. Now the rally has been led by central banks across the world, and they've all been loading up on gold to diversify from the US dollar. I've been telling you for some time that the dollar will have a pretty bad year. That doesn't mean it's going to be today or tomorrow or even next week or next month or in 2 months or in 3 months. But very soon, things are about to change. We're entering into different cycles. Today, the World Gold Council released a very impressive report for quarter one of 2016, in which it is clearly reported that gold had a 21% increase year on year. Now, that sounds like nothing, or it sounds like everything, but here's what's the big deal. The big deal is that this makes quarter one of 2016 the year that it had the second largest quarter rise on record. Now, the increase was mainly driven, obviously, by huge inflows into ETFs, which are exchange-traded funds, about 340 T on that. Now, this is fueled by concerns pretty much from different things, and they're all rising around and a part of the shifting global economic and financial landscape. Now, the biggest buyers of gold in quarter 1 of this year are obviously central banks, like the Fed and so forth. They've been very big buyers of the precious metals, but it is also very well reported that many hedge funds and even large to medium-sized and even small-sized banks have been loading up on gold. Now, the demand by central banks increased by about 28% from January through March. So from day one, since the markets opened in this year till March, 28% rise. If we compare this to the same period last year, it's the difference is 28%. Excuse me for confusing you there and myself. So the major driver for gold purchasing, for the purchasing of gold by central banks, is pretty much seen by economists after the review was done as a trend towards diversification away from the US dollar. The US dollar for the last 2 years has been has been in very high demand. And right now, what's happening is economies across the world, from countries to central banks to hedge funds to everything else, are pretty much seeking protection against currency volatility, which is something we will see a lot in quarter 2 and quarter 3 of this year. So most definitely quarter 2 and quarter 3 will be very volatile for currencies, which is good for us. It's not good for scalpers. It's not good for people who are very active in the market. It's not good for people who don't know what the hell they're doing. It's not good for people who use high risks, who have no systems, and you guys get the point. It's good for people who are just relaxed and waiting for opportunities. So if you want to make money this year, I fully recommend that you just chill out and open less trades. And I'm going to explain that soon. So why gold prices have been driven by this is basically India's back in the market. India, one of the world's largest gold consumers, returned to the market after pretty much a very long and very important strike by the country's jeweler association. India is very big in the jewelry industry and is a huge consumer of gold. I don't think we have any people from India here, but if we do, they would obviously know what I'm about to say, and that weddings in India, for example, in many countries in Europe and in North America and Western countries, people give gifts, money, presents, blah blah blah. Down there, they give gold, a lot of it. So when it's wedding season, gold goes wild over there. Now, demand for gold in the US has climbed the most in 30 years. I'm going to give you a couple of facts right now. The total supply of gold in quarter 1 has risen by 5%. Jewelry sales has dropped by 22%. And investments, and this is the interesting one, ETFs, coins, bars, I'm talking about solid gold bars, rose by 119%. That's big. Now, what grew gold's demand is a question that I will answer to you. I can summarize this in 3 bullet points, and that is number 1, NIRP, NIRP, which stands for negative interest rate policies. And you all should know this. They have been implemented by 2 central banks, 2 very big central banks, Japan and Europe. Now, what does this do? This represents a very big and unorthodox shift to unconventional policies, which generates what? Great uncertainty. Big uncertainty. Point number 2, China devalued its currency. This fueled much fears over the country's economic health, and you guys remember that. Anybody that watches Bloomberg got annoyed by it because all day long they were speaking about this. Now the economic health of China obviously by devaluing their currency, has risen a lot of concerns, a lot of fears. People became very skeptical. And the second thing is the potential impact China has on global growth. Now, number three is a recent one, and we've stated this in the emails we send out, and even in private conversations with clients. We said that the pace of the U.S. interest rates is slowly coming down. We only expect one hike this year, maybe even no hikes this year, but that's increasing the demand for gold. Recently, we saw gold fly up, and this is a very big move. And this is a daily chart, and you can see from the open till the close is pretty big. Obviously, we had a corrective phase. Yesterday, we told you to buy gold. It went up. Today, we didn't say much, but we're waiting for gold to go higher. But I will get into the analysis a bit later on. Now, the uncertainty in the markets created by all of this big pile of different factors, undermined basically the confidence in traditional asset classes. There was a lot of turbulence in the stock markets around the world. Now, the impact of NIRP, which is negative interest rate policies, in particular, that specific little four-letter word point pretty much gave gold the investors to push higher and end the year for the first time in a few years higher. Now, this, and I'm going to make a very bold statement here. This is my personal belief, and there's other people who agree with me on this. But I believe that this could be the start of a very strong and new bull market for gold. Historical analysis, if you review historical analysis of gold, of previous bull and bear markets, the cycles of them, my statement is very supportive of this idea. Even the technical analysis supports a very weak US dollar. And we all know that to buy gold, we're exchanging it against dollars, so that would make gold very strong. I personally believe that this could be one of the weakest years in decades that we'll see for the US dollar. Now, gold has experienced in total, since the 1970s, 5 bull and 5 bear markets. Okay, since 1970. In 1974, I've sent this in an email and told you this before, the president of the US changed the standard of gold. So I'm going from 1970 till today. Well, yeah, till December this year. Okay, pay attention towards what I'm saying, and I'm gonna send you a screenshot of what I've drawn. Bull markets begin January 1970 and lasted till January 1975. The total gain in gold is 451.4%. In January 1975, the same year that bull market ended, the first bear market begins. 1975 till September 1976. Total decline in gold, 46.4%. We begin the next bull market, October 1976, 1 month after the bear market ended, till February 1980. Total gain, 721.3%. The next bear market begins the same year the bull market ends. February 1980 to March 1985, 5 years, 55.9% down. Bull market, March 1985 till December 1987, plus 75.8%. Big crash happens in the market, 1987. There's a movie about it called Wall Street as well. Bear market, December 1987, March 1993, minus 34.7%. Obviously, there were fluctuations between this, so it could have been gone even lower than that. April 1993, our fourth bull market begins and goes all the way till February 1996 with a gain of 27.2%. February 1996, bear market begins till September 1999, 39.1. And here's the last bull market we were in for gold. It's pretty big, but not as big as the bull market number 2 of 721.3% gain. October 1999, September 2011, plus 649.6%. It's a big gain. In September 2011 till December last year, just a few months ago, we ended our last bear market by 44.1% down. Now, how are we defining a bull market? We're defining a bull market by a period where gold rose versus the dollar for at least 2 years, and a bear market where the price dropped for the subsequent period. So exactly the same thing. If it drops for 2 years in a row, we'll call it a bull, a bear, and if it goes up by 2, we'll call it a bull. Now, previous bear markets, obviously excluding the one that we are either still in or ended in December, have had basically a median length of 52 months, during which the price of gold declined between 35 and 55% throughout the fluctuations of it. Now, as of December 2015, gold's price pullback was already pretty much in line with the median length and magnitude of previous bear markets. So what does this indicate? This indicates that history shows that 2 consecutive quarters of strong returns have typically resulted in even more rallies in gold. So we've just passed quarter 1. We've had a pretty decent rally in gold. It's nice. It's not that bad. So if we go from January, okay, that's when the market closed. Okay, here it is. I'm going to show you. Here's the first open of this year. You can see it here. 4th of January. That's when the markets opened, and that's when we began. That's when our bull market began, and it lasted all the way till quarter 3. You can see a very sharp rise in this, and I know the chart looks a little messy, so we'll just remove this stuff from here. Okay, there we go. Okay, so here it is. That's when the markets opened and we had a shot up. You can see till then we've been going down, and right now we're going up. We obviously created, this could be a very, very nice double top formation, but we'll just have to wait and see if that's correct or not. So if we have another quarter of green for gold, if we have another 3 months of gains, we are turning, and historically, we are turning into something pretty strong. John says cup and handle. Yes, sir. Yes, you are correct on that one as well. We'll go into technical analysis of this pretty soon, just as soon as I finish. I'm almost done on gold. So far, we've had one very strong quarter. Inflows into gold look set to remain robust in second quarter of this year, because the current macroeconomic environment represents supportive for both investment and central bank demand. In clean language, that means that everything that's happening right now in the world, everything technical on this chart over here as well, which I'll speak about pretty soon, supports the idea that we're going to go higher. That doesn't stop price from dropping down before going up, because nobody can tell you that, but I can tell you that in the long run, in the next 6 to 12 months, you'll see gold much higher than where it is right now, even in 3 months. Okay, so I'm gonna pop into that there, and I'm just gonna go over something very, very important and explain to you when it comes to trading a little bit more about moving averages, okay, and how they can help you find medium to long-term bear and bull markets trends. Is anybody aware of something called the golden cross and the death cross? Does anybody know about this? Okay, so let's go. The golden cross and the death cross are pretty much the exact opposites of each other. Okay, I'm going to explain to you what they are. This white moving average here is a 20 moving average. We're using only a daily chart because I've explained why we're using a daily chart, because we want the last 20 days. This is a short-term moving average. This one over here is a 370 moving average. And this one over here is a 987 moving average. This one over here is a 55 moving average. Exponential moving averages. Okay, now a golden cross is this. It is when a short-term moving average crosses with a long-term moving average. Preferably what the golden cross to us is this here. If these two cross, that means if the white goes above the purple, that's a golden cross. The golden cross indicates a long-term bull market. That means we're going forward. And the death cross means the opposite of it. You guys already understand, but I'm just going to show it anyway. Here's a death cross. Short-term moving average crossing a long-term moving average, and a real death cross is right here. And I just want to show you where we are at. We are at somewhere just after the beginning. Here's one and here's two. Just after the beginning of our bear market that started 2011 when I told you so. And that's September 2011, and that would be September 2011. That begins, and then we have the crossings over here. We almost crossed over here, but we didn't. Kept going higher. So this was a confirmation of moving averages. They always come late. They will never tell you up here that this is going to be a bear market or a bull market. Nothing can do that to tell you. Only if you have 10 trillion in your account and you're ready to sell gold, well, then you're going to move the markets pretty well. So, like I said, the golden cross indicates bullish markets, bearish cross indicates bearish markets. Now both refer to both are actually pretty solid confirmations of long-term trends. Like I said, when the occurrence happens of a short-term moving average crossing over a major long-term moving average, then you create the golden cross. And it could be happening here, and we could actually be popping into something much sooner than in reality, but I just want you to pay attention to gold and its very sharp movements. Okay? Gold has very sharp movements, and this image over here is very similar to what's happening over here. So, you know, I'm not telling you it's going up or down right now. I'm telling you it's going up in the long term, because we've already had one cross, and they don't cross that often. They do not cross very often. But hey, you know, I could be wrong. Death cross is when they're crossing downwards. 1, 2 here. These are good indications and confirmations of entering long term. Now, here's the deal. When you're trading long term, you can't have a stop loss of 20 pips, 30 pips, 50 pips, even 100 pips. You want to have 5, especially on gold, you want to have 1,000, 2,000 pips. That's like 100 or 200 pips in reality. But even more would be useful, because you need to let your trade breathe. If you don't let your trade breathe, you're risking of getting stopped out, and then price could go into the direction you wanted it. Now, if we use volume, trading volume, if we connect it to these crossovers, that can increase our chances, but also they can also, these crossovers indicate to us support and resistance levels. Okay, when they happen, they give us support and resistance levels. And you can see them work a few times. You see that? You clearly see the drop here, drop here, drop here, here. There's a broke area there. And we know that if price breaks this level over here, then we can be targeting this level here as basically either a stop loss or a take profit. And if I keep going back, pay attention to the yellow line, you'll see it work again. You see, they are working again. It doesn't happen anymore, so that's it. Now, once the crossover occurs, the long-term moving average is considered, like I just said, a major support. In this case, the golden cross, or resistance when there is a death cross. So let's point out the resistance real quick. There's a cross right there. So that's our 100%, 150% level. And then we have another cross up here, and that's our 175% level. So you can mark this down as this will be, when gold starts gaining, this will be the major support, resistance. And once this is broken, this will be the next one. Now, that's pretty much it for gold. What I'm going to do for everyone here is I'm going to send you an email once the analysis and trades section of the website is updated. So much more information will be added on this, and I will be creating a morning video tomorrow for gold and for a few other trades. But what I'm going to do from now on in those videos is I'm going to create one just for metals and one for currencies. And that's pretty much it. So, does anybody have any questions for me? I suppose no. Okay, we do. Yes, Cato is asking, does it matter which short-term EMA breaks the long-term EMA? No, we want the white one, the 21 to break. The red one is not so important. It's the 21 that's important. The 20, the 370, and the 387. These three are important. This one here, we're just looking for short-term crosses that will allow us to try grab trends before this happens. Because the first to cross are the red and white one. And once they cross after our mathematical points of interest, they become extremely strong areas to sell and buy. Okay, like here, for example, we had a cross, and it was clearly an excellent sell. But here's the cross. You see, it happens first on the short-term ones. It happens first on the short-term ones, and then it happens on the medium-term one, and then it happens on the long-term one. This is more riskier to take. This is more surer to take, and these are usually the surest to take. Because as you see, there is a massive crossover of purple, white, and red. So 2055 and 987 have crossed here, and that gave us an excellent indication of selling. Because as you see, if somebody were to sell somewhere here, price would have reached. Why is it hard to trade trends? Here's why. Let's say you're in profit, that's 20,000 pips. I mean, surely it would have closed or be stopped out by then. But let's say you're in profit 3,000 pips. Most people could not bear to see their account go back to 700 pips in profit, let alone go negative 300, 400, when you were in profit hundreds and even thousands of pips. Trend following is the most profitable way to trade, but it's also the hardest. I've explained a couple of things to you all before, and I'm going to explain them to you now. In order to trade profitably in the financial markets, what do we need? We need a few things. One of them being the correct mindset. So USD CAD is on the move, as I can see, because I have pending orders open there, and that's going pretty well. So you can see that the dollar is slowly going to lose its power. But anyway, we'll come to the analysis pretty soon. Kato, have I answered your question, my friend? You're very welcome. Okay, so let's go to gold. Like I said, we are very close to the final cross of moving averages, and that's the 987. That's the 987 with, let me just remove this. That's the 987 with the 20. So that's going to be really important. If that does happen, we can see a floor over here, around this area here. We do see a floor, just like before. We had some breaks out of it, but we do see a floor, and we could be in for a very nice flag. So I believe in the next 48 hours we can see gold rise. If you are willing to take trades like this, I fully recommend much wider stops. Like I did say that before, and I'm telling you now, you also need some good risk management with that. This can cross, and again I'm using the word can, it can cross, and don't worry, you won't be late to jump into a trend. It's always more profitable to come in late. It's not always more profitable, but it's safer to come in late than right away, because you'll be taking a few risks. Craig, is Craig here? No, Craig's not here. Craig sent me a message recently asking me the following. He asked me, because we sent out that trade the other day, and he told me, let me just find it. He says, "Hi Dennis, how are you? I'm looking at the gold trade you had on PipsMatter, and watch the analysis. I see it's moved up 1,100 pips so far. Nice one. Am I too late to enter it?" I replied to him that I was busy. I told him blah blah blah. I told him that I'm going to be giving him the information later on. So I sent him the information at 12:25 p.m. today, Central European time, and before that I told him at 10:15 p.m. I told him to just wait, and I'll give him a signal if there is something on this pair. And I sent him 2 hours after that, 2 hours and 10 minutes after that, that it looks ready to move higher. If you enter it, go small, under 1% risk. Then slowly go up and compound. I do believe that in the next 48 hours, so let's say anything between now and the next 3 to 4 days, we will have the cross. But before the cross happens, because this is the last 20 days, we need some movement upwards. So I think that the cross will occur when price and candles reach around this area again. So let me just remove this. Once price and candles reach around this area, the cross will happen. So maybe even less, maybe about here. So if price reaches around here, then we'll have something that I just told you is called the golden cross, and price will shoot up. But again, you see gold. Gold moves up, gold moves down, gold moves up, gold moves down. Don't get out too quick, but don't stay. Okay, just make sure that your positions have small risk. You can compound it eventually. Even if you start with 0.1, you can eventually be at 10 lots without a problem. Just make sure you get in small, so you can manage those trades, so you do not allow your judgment to interfere too much with what's going on. You need to have a clear mind. You need to have one objective when it comes to this, and that is to stay with the trend and make money. I've told you this, and I'm going to keep saying this, just like I used to speak about stop losses. Right now, there's a couple of trades that are in my close attention. Gold being one of them, and this potential crossover towards up, which is a golden cross, and a potential flag pattern here, a bullish flag pattern, which could see gold rise. Could see gold rise a good, well, right till about here, somewhere there, in this quarter. Not obviously in one go. As you see, gold goes up, gold goes down, gold goes up, gold goes down. So the next one is Euro USD that I want to talk to you all about today, and that is one second. Okay, we've had the first cross of the short-term moving averages. This was an ideal crossover here, as you see. They were all pretty close to each other, and when they crossed, we had a very aggressive down movement. Purple is a bit far, so we can. That's why I said end of, well, let's say quarter 3, quarter 4, because that will give us enough months to either climb up here or retrace downwards and then go up. We have a clear channel on this pair, and I can see Euro USD also heading higher. We've had recently a cross here. We didn't cross the first time, but second time we did, and I can see price shooting up anytime after 115. If 115 is broken with enough volume, then we can see Euro USD go much higher and target the 120 area again, and that's going to happen pretty soon. Right after that, we have, like I said, I just missed that out. We said about gold, so we're expecting a big break on Euro USD. On gold, we're expecting a new bull market. On AUD USD, we're at a key resistance point, and we've told you this before in the trades as well. We've had a few crossovers here. It could be false. Let's see. We've had recently a change in interest rates in Australia, which pushed this short-term bear market upwards, which started at this year with gold. I just want to show you that. Started with gold. Here it is. Started right there with gold. Here's the beginning. And we started with gold, and then Australia lowered its interest rates, and that pushed it down. And this was this day here, and then it continued going down. Yes, John, I will. I will show you how to add the lines, the exponential moving averages. I just want to say very quickly about this here. We are at a very key and very important resistance point. Support, previous resistance. What I want to tell you about this all is, yes, Peter, Australia does want to be weak, and that's what I wanted to speak about, correlations. Australia is connected to gold. Many people, when you buy gold, you can also buy Australian dollar and profit from both of them. But here's the deal, and here's the difference. This is down, and where's gold? Anybody see gold? Here it is. Gold is up. You see? So correlations don't always happen. Australia can even break this level and head down to the 69 area again, which is a 75% level, and even lower before joining gold. It doesn't have to follow gold always. That's a misconception by many people. Sometimes it takes 2 days, sometimes 5 days, sometimes 2 months for one currency to follow a commodity. And correlations do change sometimes here and there. And as you can see here, it's changed. I do not recommend anybody opening any trades yet. I do recommend you to wait, add in alerts, so you can be alerted if something happens in the markets, so you can start paying attention to what can be happening. Okay, so I recommend just AUD USD alerts. Stay away from it from now. It's at a key point. It could bounce higher to follow gold for a little bit, before either Australia, like Peter says, cuts again, or further bad news comes from there, and then it just shoots right back down. So I'm going to show very quickly once again. Excuse me, I'm a little tired. I'm going to show very quickly how we put the moving averages again in here. So I'm going to add them on oil. John, we go over here. You can write even in the search expo, and then you'll find the exponential moving average. Once we do that, we'll put 20 periods, close 20, and just for the sake so we all understand each other, we'll make the weakest one white. And here it is. Then if you don't want to do it in the search, you can just go to trend and go to the fourth one over here, which is exponential moving average. Go to that again, put 55, make it red. We'll go here again. Next one, 370. I make them light purple. And then the final one is the 987, and that's dark purple. Okay. And don't forget the 55 one, John. The 55 one's important as well. So we're using a daily chart, John, and it's very important to use a daily chart because we want the days. If we were to go on a 4-hour chart, these moving averages totally change. They don't mean what they mean. Okay? They can be used on smaller time frames, but they recommend different numbers in smaller time frames. We use the daily chart because we're trying to find long-term trends and make the most money possible out of this. You're welcome. So next one, we have a depth cross forming, and that is USD JPY. You guys remember the depth cross is when prices go down, when we go down. So here we go. I'm going to remove everything from the screen and just leave the prices over here. Here is our formation of the golden cross. We have the first indication, just like Euro USD, if you guys remember, the first indication of a selling point, and that's here when these two crossed. And now we have the third one crossing, the final cross. This can be pretty big, and as you see over here, price drops, reverses, price drops, reverses. Could reverse a little bit more, but I can see USD JPY going aggressively downwards. I always try and kind of go against what the media is saying and what people in general are saying in the forums. I just like to think for myself. So this is what I found, and this is what I believe will happen. I'm very many times wrong, but when I'm correct, I cover up for all the wrong times. Now, the final pair that I'm going to talk to you about today before I ask you about any pairs is GBP USD. Here's GBP USD. Just going to clean up the chart, and I'm going to tell you right from the bat, this is going to be a very, very active market. There is big things coming to the cable, big things, and we're just going to add everything in. Big things are coming. There is no crossovers with big and with long and short term moving averages, and as you see, it doesn't support it many times, but I'm just telling you from experience and from understanding what's happening, there is massive things coming to this pair. I'm not talking about crazy Thursdays and crazy Fridays and Black Mondays and blah blah blah. I'm just saying this market is going to be very active. It's going to be like a pulse when you're watching it on a heart monitor, up down, up down, up down, up down. Then it's going to be a big one because somebody gets scared, and it's going to drop back down, and it's going to be pretty interesting. So try to avoid it as much as you can. And when there is something strong forming, I will always inform you, just like I always do. Now, there's going to be another course tomorrow, and there's going to be a video that will be released tomorrow as well. Is anybody joining tomorrow's workshop? It's at around 5 o'clock British Summer Time. Should be quite early for Peter, so I don't think he's going to be awake. But what about everyone else? That's right, Peter. Oh, John's in Korea. What do you do in Korea, John? If you don't mind me asking. You're obviously in South, right? Not in the North. I think you wouldn't be speaking to us if you would be in the North. Good. Okay, does anybody know who John W. Henry is? Okay, even if nobody knows, I'm still gonna go for it. If there's anybody watching baseball here, supporting Red Sox or hates Red Sox, they know that John Henry owns the baseball team Red Sox, but also he owns, for any football fans over here, Liverpool Football Club from England. Now, Red Sox is priced over $700 million, and Liverpool is priced over $500 million. Obviously, this man is a billionaire. Now, the question many people ask and should ask and think is, how does this person make this money? Did he inherit it? I'm going to tell you right now, no. What did he do in 1995? Well, Henry was a farmer. Today, Henry is a billionaire. So the difference between all of this is pretty small, and I'm going to tell you right from the gut. Henry made his money trading. He made all his money in trading. And trading, I mean by trading in a very strict and rule-defined way. That's how Henry became a billionaire. Henry doesn't share his secrets with people, doesn't talk about how he trades, speaks in code, has a secretive little group. But Henry was a farmer in 1995. Henry is a billionaire right now and makes a lot of money trading different markets. Henry is not the only person that's become very rich trading. I've posted on the Facebook page about taxi drivers becoming billionaires. And there's so many more stories of that. Every single multimillionaire, millionaire, or billionaire, or a person that manages trillions in the financial markets has made the money himself or herself. So what I'm trying to tell you here is that becoming rich, smart, successful, and even healthy is a fight. So I don't want you to make any mistake about this. This is a fight between your bad and your good. And that fight starts every single morning you wake up. Every day. I can call the fight, and I will call the fight right now, consistency. And the middle name of consistency is everything. Consistency in everything. How does Henry, Warren Buffett, or Robert, or David, or anybody else make so much money? They make it by being dedicated. So speaking about that, they make it by being passionately dedicated to a cause. How important is passion? Well, there's nobody better than the author Bert Steenbarger, and he puts passion into perspective in the best possible way. Here it is. Find your passion, the work that stimulates, fascinates, and endlessly challenges you. Identify what you find meaningful and rewarding, and pour yourself into it. If your passion happens to be the markets, you will find the fortitude to outlast your learning curve and develop the mastery needed to become a professional. If your passion is not the markets, then invest your funds with somebody who possesses an objective track record and whose investment aims match your own. Then go forth and pour yourself into those those things that fascinate you of life and that will keep you springing out of bed each morning, eager to face each day. That's passion. So I'm going to give it to you straight. I'm always going to give it to you straight. If you do not have passion for the markets, I promise you, you're just going to lose your money. Worst of all, you're going to lose your time. If you have something you're passionate, I'm extremely passionate about the markets. I'm just telling you directly right now that if you're not effing become passionate, because you can do a lot with this market. If you're unpassionate because somebody has been teaching you some nonsense, or somebody has lost your money, or somebody has scammed you, or things like this, forget about that. It happens to thousands of people and millions of people yearly. They lose, they get scammed, they get destroyed, they make mistakes. Stick to it. The learning curve is the most beautiful thing you'll go through. It's tough. Your hands will sweat, you'll cry, you'll be pissed off, you'll lose friends, you'll make enemies, the whole deal. But that's life. And if you want to be successful into this industry, I promise you, just develop the passion to go by it. Be a part of something that helps you. If this is helping you, if I'm teaching you something good, then stick around. I'm making a community soon. That community is going to be insane. It's going to be a social community. It's going to be, if anybody's read Think and Grow Rich by Napoleon Hill, it's going to be a mastermind group. That's exactly what I want to create. And if you haven't read Think and Grow Rich, just Google Think and Grow Rich PDF. Start reading, or go to Amazon and buy it or download it. It's a book that can really help you find your passion and open up your eyes to many things. Okay, sure, Peter, sure. But well, Lisa, I'm very inspired because of everyone that attends these webinars. A little sneak peek for everyone that's here, and I'm going to stop recording. Actually, I'm not going to stop recording yet. I will just edit the video later on. Okay, so what I'm creating is something pretty. It's going to be pretty amazing for anybody that's going to be involved. It's going to be basically a social community, like I said, a mastermind group. And in this group, there's going to be a lot of teaching, a lot of lessons. We're going to be doing things together. You'll be able to communicate with other people from the group, and it's all going to be done on either your smartphones or your computers. You can do it both ways. You'll be able to receive signals directly there. For example, when I open trades, you will see that Dennis just opened the trade, and you guys can review my trade and say, okay, I'm going to follow this trade or not. You can comment on the trade. You can speak to it. It's going to be insane, but it's going to be limited. I'm not going to allow just anybody to join. The last thing we need is some, douchebag, excuse my language, bothering us, or some smart ass or something like this. I don't need those kind of things. I need people who are interested in learning, people who are willing to learn, people who want to grow. That's the best way I can put it. I'm looking for people who want to grow. And the essence of success is growing together. Like I told you, for example, let's use Warren Buffett. Warren Buffett didn't become a billionaire by himself. He became a billionaire with his team, with people. So it's going to be something pretty interesting, and there's going to be a lot of things involved. So it's going to be pretty cool. Well, Simon, you know what? You never know. It takes time to do things. Peter, I'd love that. I'd love that, and everyone's going to be a part. Everyone's going to be a part in their own way. It's going to be a community that grows, a community that creates. It's going to be the whole deal. You know, we'll be like a person. Um, some will be the brain, some will be the heart, some will be the stomach, and some will even be, uh, assholes. But you know what? That's the body. So we need to be all together, to create something that grows, something that continues, something that evolves. Now, I study a lot of psychology. I read a hell of a lot. I mean, while I'm creating these workshops, I'm sitting here with another book and reading that. Well, there's a PDF on my computer, and I'm reading that as well. So for me, it's very important to constantly improve my knowledge, and I don't have the time always to do so, but when I do have the time, I make the most of it. But there's one thing that I don't use, and that's common sense. In anything that I do, I use common sense because it's obviously common sense. But using common sense to judge markets is not a good way to find and judge markets. For example, a simple moving average, an exponential moving average won't tell you this is a trend, and sometimes you're going to get busted out of. But we'll talk about things a bit more, and I'm just going to leave you guys with one final saying on that, and that's, if you take emotion, what I mean by emotion is could have, or would be, could be, should be, or should have, would have, could have, out of it, and look at what is and what quantifies it, and I'm talking about the trend or the market. I think you have a very big advantage over most human beings. So I want you just to take out emotions out of your trades. It's the worst thing. The worst thing is this. Let's say you have some trades open. I really hope Craig took that trade, because I told him to buy, and I really hope he took it, because I really hope he did, because he's not in the workshop. He is not in the workshop, and this is going up, 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 and away. My good friends, does anybody have any questions for me? Or perhaps is there any trade or specific market you would like you would like me to look into? Okay, Lisa, that's excellent. I'm really happy you did. I didn't tell anybody to do it. You're talking about an investment, Simon? You're talking about to start with $100 or $1,000 or euros, or okay. Look, it doesn't the amount, your capital is obviously important, but it's not. Look, whatever, regardless of with what kind of amount that you start with, you need to have a plan, and to create that plan needs to have many things, such as a trading system. You need to know how to follow the rules. I always say that it's always better to trade with real money than what's it called, practice accounts, because you actually start feeling it more. You understand. You need to learn from it. Unfortunately, we as human beings don't learn so much from things, because we create habits like, listen to this, like that. We'll create a habit so quick that we'll just keep adding on money, and that's called a gambler. People think that they change something, but in reality they don't change anything. They just keep on doing the same thing, doing the same thing, doing the same thing. They lose money, they make a little bit, and they keep doing the total opposite of what made them money. They just keep over trading and things like this. So to answer your question, no, I don't think it's a bad idea. I think it's an excellent idea. But if you follow something, if you have a specific plan, I know of people I know of people turning $250 into 30, 40,000 in a matter of days and weeks and months. I know of people turning a few thousand into millions. I myself have turned small amounts into big money as well. Yes, right. It doesn't. That's correct. Now, here's the deal. And if I can give anybody advice, like I'm going to give you, Simon, right now, is this. The amount you invest is and isn't important. I know that doesn't answer anything, but I'm just saying. More money will make you more money. Less money will make you more money in a longer time frame. But here's the deal. Here's what I want to say. And for example, I've created plans that will be on the website pretty soon of how you can save, for example, in just a few months, $2,000, starting with $5. If you start saving, and I'm going to give you a breakdown, and I'm going to send you all this in an email once I put it on the website. But here's what I recommend people to do. If somebody doesn't have too much, or even if you have far too much, I still think investing savings, making the money, saving it up, and then investing it is a great way to invest, because you appreciate it so much more because it took you months to create. So let's say you start saving on January 3rd, and by 11th of July, by adding on $5, just $5 per week, you can have $2,030 to invest into a trading account in no time. Just what, 6 months, less than 6 months? So, January 3rd, $5. You add $5. January 10th, you add $10 because you're compounding it by $5, okay, per week. You start with 5, and the last week you give 140. We can all save somehow and make this money. But listen to this. $5 first week, second week $10, third week $15. On the 10th week, we're adding in $50 or 50 euros or francs or whatever. On the 20th week, we're adding $30, and on the 28th week, we're adding $140. That all adds up to $2,030. $2,030 that I fully don't recommend you spending on clothes or new phones or video games or drinks and food. Thanks for coming, John. Tomorrow's the next one. You won't be here, but we'll send you the recording. You all will receive the recording. So here it is. I don't want any... Thank you for coming. It was a pleasure having you here, and I look forward to getting to know you. So, in 28 weeks, by adding on $5, compounding it, we can make $2,030. My recommendation to anyone is to become extremely interested in investments. Become obsessed with investments. You remember, guys, how I told you this is the floor? Price did touch here and go up. Lisa did take the trade, and I'm really happy that she did, and I'm sorry, everyone, that I didn't tell you to do something, but I always prefer not to directly give something. So anyway, the reason I'm telling you not to spend your money on silly things, especially savings, spend your salaries on silly things, but always pay yourself first. So always, whenever you make some money, pay yourself first. Before you pay the tax man and the rent and the bills and the food, take out $5, put it on the side. Next week, take out $10. I mean, you know, we pay most of us get paid monthly, and even if you get paid weekly, it's even better because then you can do it directly. And if you invest that money, the simple $2,330, maybe more if you can, then that's your capital. There you go. And what are you doing? You have 28 weeks to learn. You've got 28 weeks to improve your knowledge. Huge advantage. Imagine popping in with $2,000 on week 1. Chances are by week 6 or week 2, you're out. Lisa, you're very welcome. I'm sure that you guys appreciate me being honest, and I also appreciate everybody else being honest. Thank you for coming, and see you tomorrow. Simon, yes, it would. I'm gonna speak to you later on and just explain to you a little bit more about that. But yes, it would. Most definitely would. You're very welcome. Very welcome. So what was I saying? I was saying you use time to your advantage. You would basically take the time, the 28 weeks, to improve your knowledge. Okay? Seriously improve your knowledge. And by the time you do it, you're still learning and you're creating an incredibly strong habit of adding lousy little $5 that most people spend on nothing on something that can help you become something. And I guarantee you, once those 28 weeks are over, you're gonna know exactly how to turn those $2,000 into $20,000 in a matter of nothing. So I hope you guys understand it. I'm gonna write an article about this and show you the progressive side of it so you guys can understand. But here's the reason why you should not spend that money on something stupid. Because one day, when you're below the ground or in ashes or whatever, no one's gonna come at that funeral and say, Dennis had a nice phone, or he had really good shoes. No one's gonna do that. And if somebody does that, I mean, that's the silliest thing I've ever heard at a funeral. There you go. Peter put his first $10 away. I've just literally put my hands up in the air and could, like, literally rooted you on. Do that. I do this all the time. All the time. I've started a few months ago to do something like this, but I do it all the time. And I do sometimes randomly when I have a couple of extra bucks, 50, 100, I take 50% of those extra money and just add it in there. Just imagine what's going to happen after 30 weeks or 28 or 25 or 10 weeks. I could have like 5, 6,000 on the side that I'm going to invest, whether that's in stocks, gold, whatever, but I'm going to invest it. And if I lose it, so what? It's obviously it's very important. I'm sorry I said so what, but it's really important not to lose that money. But I'm just saying, you understand? It's money that you're using for investments. Don't lose your money. Don't even think about it. Forget about what I said. Any questions before I shut this down? You're very welcome, Simon. Peter, have a good night, my friend, and see you tomorrow morning. Or the day after for you, I think. Kata, you're very welcome, my friend. Pavi, you're so welcome. I will call you. Pavi, I'd like to call you as well. I need to speak to your fiance. But I'm gonna mail him directly. So I'd like to thank everyone for coming. I really would like to wish you all to see sunshine where others see shadows, and opportunities where others see hard work. That's my wish for you today. Thank you for coming.